David, hi.
Hello.
June is a pretty big month. There's lots of meetings. So what should people be looking out for?
Well, there's the normal kind of run-of-the-mill interest rate stuff that's going on. By the time this has gone out, we'll have probably had the Feds and we'll have had the ECB, I think. And I think just looking down my list of things here, we've got the BOE, Bank of England decision on the 21st of June. So, you know, but we sort of know roughly what all that is. That's all about increasing interest rates. Well, maybe not in the UK, but probably increasing interest rates and the various central banks starting to scale back or even intensifying their scale back of their kind of quantitative easing. So we'll be all watching for the fairly obvious signs that the US Fed is worried about inflation. So the kind of core inflation rate's gone up to 2.2% in the US, and the kind of headline one is at 2.8%, and that will have, I think, probably freaked the US Fed out and will give any more narrative than they need really to increase interest rates. And the ECB will probably be under similar pressure to sort of increase interest rates and do something. But I think the other thing you've got to watch out for, looking down at my list of things, is the 22nd of June is the OPEC meeting. And oil prices, which I know we'll come back to, I think are quite interesting at the moment. They tell us lots of things about exchange rates and inflation concerns. And I think the other thing to watch out for, which I always watch out for, is I think it's on the 6th of July, I think we got the US non-farm payrolls, which is basically an indicator of job creation in the US economy. And the reason why, I mean, that's a regular measure that comes out. The reason it's interesting this time around, though, is people are wondering that the US economy is probably, certainly doing well, but could be what we use a term called late cycle, i.e. you've got a business cycle, and business cycles can last anything from 3 to 10 years, and we're quite long in the cycle at the moment. And that's sort of, how far along are we in the cycle? Are we as near peak capacity, which is where the inflation concerns come back in? If we are, you tend to see interest rates rise more sharply, and that tends to indicate a likely slowdown. Or have we still got some slack in the system in the US? Is there still a lot of job creation going on? And that's not quite black and white, that one isn't, because so people sort of relate job creation to unemployment, but actually there's a different relationship going on. There's a lot of people who are basically been off the job register, who are not technically unemployed, but are not active in the labour market, and they can come back into the labour market. And though the official unemployment levels are quite low in the US, as they are in the UK, the activity rates in the US, i.e. people who've withdrawn from the labour market, are quite high, and you could see a lot more of those come back into the labour market. So you can have a paradox whereby you can have very low unemployment but still a lot of job creation. And if the economy's got more slack in, then it could keep going up for longer, and that could stave off interest rate increases more. So US non-farms payroll on the 6th of July is one to watch out for.
Okay. You touched on rates going up, the Fed. We also have the ECB meeting, and you said the Bank of Japan, well, who knows what they're doing right now. But what does this mean for currencies?
Well, I think FX markets are where anybody who's interested in a kind of short-term speculative trading strategy need to really focus. Right. Because I think there's lots of stuff that's kicking around, and the FX markets are the kind of canary in the coal mine at the moment. They all tell you the way certain things are going. So the big story has to be the dollar. The dollar and the strength or the weakness thereof affects lots of things. It affects interest rates, it affects bond yields, it affects, in more indirectly, equities, certainly affects commodities. And therefore, the big story is what's the dollar? Where's the dollar at the moment? And at the moment, I can't work out. There's a paradox going on. So by many objective measures, the dollar should be weakening. Okay, and the reason it should be weakening is and I've talked about this on this program before in the past. Lots of technical reasons why. It's clear that the Chinese, for instance, are probably trying to move away from being net buyers of US government securities to being a more neutral position. They're worried about their over-concentration on that. US hedging costs are very high at the moment, and that's freaking out a lot of people on FX trades at the moment. Other central banks are beginning to move into action, particularly, we already mentioned ECB, and looking to, if not certainly scale back their intervention, and maybe even increase interest rates. So on many conventional measures, we should be seeing weakness in the dollar. and I'm not forgetting, Trump wandering around the world annoying all his allies, and talk of trade war. All of these things should, on many respects, be worrying investors and saying the dollar's overpriced. But actually, we've seen, for instance, the trade-weighted measure of the dollar, which is a bunch of exchange rates all added up together, and it gives you the kind of effective dollar rate. That's relatively near all-time highs, and it's actually strengthened in the last few months. And interestingly enough, hedge funds have been ahead of that. So hedge funds are very net long the dollar at the moment. Numbers are coming out recently saying they're very net long the dollar. So there's something God going on, and the reason why it's really important, and the reason I'm labouring it, is there are only two narratives that make sense at the moment. Narrative one is the dollar is strong because people are worried. So It's a safe haven asset, yeah? And they're worried that there's more bumpy, volatile times coming, and that maybe, there's trouble ahead. In which case that explains why the dollar will be strong and you'd be net long the dollar. Or the other alternative is we are basically kind of in a synchronized global recovery. The recovery is looking strong, and America's leading the pack, and everybody else is coming along with it. And the recovery is strong, and thus equity prices should be going up, in which case the dollar should be weakening. So, in my view, there's only two narratives out there. Either there's trouble ahead, or there's reasonably good times for all. Okay, and if you believe that there's basically good times for all, you should be shorting the dollar like crazy at the moment. I.e., if we think this is a bit of a bump, and that the global economy is in pretty good shape, and the Chinese are busily pumping money into their economy, the dollar should be weakening. If, on the other hand, you believe trouble's ahead, you should be heading into safe haven assets, you should be buying US Treasury bonds, that kind of stuff. The dollar should strengthen. So, and the problem, and the reason I'm labouring so is because the equity markets seem to be predicated on the factor that it's good times, basically. Equity markets are powering ahead because they believe that the US economy is leading the global economy. If the dollar's strong and is telling you that it's a safe haven asset, you should be net short equities, US equities. But you can't have it both ways. So that's the problem at the moment. One of those two scenarios is true. And I don't know which of those two scenarios is true. But whatever the effect is that sterling, I think that's the other thing, is I think sterling, consensus probably be short at the moment. And the reason for that basically is, we've already seen it come down from about 140, the cable rate from 140 to about 133. It's Brexit. And that ain't going away. Yeah, and there will be lots of uncertainty around Brexit. And if the dollar is strengthening and there's lots of uncertainty around Brexit, then the cable rate, the dollar sterling rate, I would suggest is in line for weakening of sterling. And maybe if we have talk about a hard exit, come back in. It doesn't seem likely, but it's possible. And there's lots of worries about falling out the European Union. You could see the cable rate sterling go down past 130. So I think that's a move that a lot of people are beginning to get their heads around. That sterling, in whatever scenario, is probably looking fairly weak in the short term.